The US dollar has strengthened pretty meaningfully this year. It's up 2% against the Canadian dollar, 12% against the euro, and a very meaningful 20% when measured against the Japanese yen. Now, part of that US dollar strength can be attributed to a faster pace of interest rate hikes by the US Federal Reserve, and in general, just higher interest rates in the US relative to its trading partners. But it also has to do with weaker economic conditions abroad. We've seen a renewed lockdown of COVID restrictions in China, for instance, and that's weighed on the economic outlook in that country. And we've seen an energy crisis in Europe that's weighed on both business and household spending. These are things that can persist for a while longer, so it's possible that this US dollar strength continues into early next year. But it's clear that in the long term, these US dollar moves are stretched, and we would expect that the foreign exchange market narrative in a year's time will be one in which the US dollar is weaker. We think that because a lot of the elements that we look at in our framework are long-term in nature, and these long-term elements suggest that the bull market and the US dollar that started in 2011, so now a decade old, is at or very near its end, and that the US dollar is extremely overvalued, and that overvaluation will now present an obstacle to further gains in the US dollar. So we think the greenback will sell off in the coming year, and that leaves room for other developed market currencies to appreciate. Among those, we think the Canadian dollar can appreciate most, as that currency is supported by a hawkish central bank of its own, by healthy immigration, and by a positive balance of payments, capital flows that remain very positive for the currency. Our forecast is for the dollar-Canada exchange rate to hit 1.19 in 12 months' time, and that generally equates to a 9% gain in the Canadian dollar.